Welcome to The Explainer. Today, we're diving headfirst into a massive and honestly pretty shocking divergence that's unfolding right now in AI stocks. If you're just casually skimming the headlines, you might think the artificial intelligence boom is this uniform rising tide that's just lifting all tech boats equally. But let me tell you, if you look under the surface, a massive fracture is happening. Top analysts are warning that the next few weeks are absolutely crucial. So we're going to unpack the data, look at some really fascinating historical parallels, and map out exactly what you need to be watching to understand where this market goes next. Let's just jump right into this stark juxtaposition. Think about the Magnificent Seven, the absolute titans of tech that are building the software and deploying the AI. They're barely moving the needle. We're talking up maybe 1.5% year to date. But then, look at the semiconductor index, the SOX. These are the hardware manufacturers actually building the physical chips, and they have absolutely skyrocketed, up over 70%. It is a profound split. We're seeing a massive gap between the companies buying the AI infrastructure and the companies actually building it. So, here's our roadmap for today's explainer. We'll quickly cover the great AI split, then move into hyperscalers versus infrastructure, look at some echoes of the 1990s, break down the critical technical levels to watch, and finally decide, is this a rotation or a tech unwind? All right, part one, the great AI split. Is the market tearing itself apart or just redistributing the wealth? It's wild, actually. Despite major tech players practically shouting from the rooftops about massive AI investments, the market essentially yawned. Companies like Alphabet and Tesla laid out dramatically boosted spending plans to win the AI race, and investors barely even blinked. Usually heavy investment in the next big thing sends stocks surging, right? But right now, Wall Street is acutely questioning the actual cost of that ambition. That leads us right into part two, hyperscalers versus infrastructure. Or, as I like to think of it, the spenders versus the builders. First, let's make sure we're on the same page about the market's primary spenders, the hyperscalers. We're talking about the behemoths here. Alphabet, Amazon, Meta, Microsoft. They are the ones actually deploying the massive capital. They're writing billion-dollar checks to build out data centers, secure energy sources, and push AI software capabilities to the absolute limit. They are literally funding the AI revolution out of their own pockets. But here is why this matters to you. Writing those massive checks is leading to some serious cash flow anxiety. When you're dropping billions on data centers, your free cash flow, the money actually left over after paying the bills, can become stagnant. It can even turn negative. And that heavy spending, it's alarming investors who want to see profits today, not a decade from now. Meanwhile, the companies cashing those checks, the infrastructure beneficiaries like Asian chipmakers SK Hynix and Samsung, are seeing massive stock gains. It is a direct wealth transfer. Money is flowing right out of the software giants and straight into the pockets of the hardware manufacturers. Which brings us to part three, echoes of the 1990s, the historical warning. To really grasp the gravity of this divergence, we've got to look back. JP Morgan's Michael Sumbalist uses this perfect analogy to describe our current market dynamic. He calls it a classic head fake. If you're a sports fan, you know exactly what a head fake is. It's when a player looks one way to totally trick the defense before moving in the exact opposite direction. Well, in market terms, it describes how the market can lure investors into a false sense of security. Right? It makes you believe a trend is sustainable right before it violently reverses course and leaves everyone trapped. And it's kind of eerie how today's divergence mirrors the exact script from 2 decades ago. Think back to the late 1990s. The communication services stocks completely flatlined due to massive overspending, while the infrastructure companies just kept climbing and climbing. Fast forward to the 2020s, and the hyperscalers are facing that exact same stagnation due to their spending, while the semiconductor and physical infrastructure sectors are absolutely dominating. This is flashing major warning signs, folks, because we all remember how that late 90s story eventually ended. So, what are the actual numbers we need to be watching? Let's get into part four, technical levels to watch, the JP Morgan scorecard. Jason Hunter, a strategist over at JP Morgan, warns that the next few weeks are critical. This is your real-time scorecard. For this AI rally to actually survive, Alphabet needs to clear its 50-day moving average at $368 and push through $381. Amazon has a really tight window to clear between $251 and $258. Meta, it requires a breakout above $69 to $694 to signal any true bullishness. And Microsoft, it absolutely must hold its $350 support floor. If these hyperscalers stall out here, the entire foundation of the AI rally starts to crack.
But wait, the hardware guys aren't off the hook either. This semiconductor index, the SOX, has to push through its own ceiling between 12,769 and 13,333. It can't just coast on past gains. Because if the hyperscalers fail to break their resistance and the semiconductor stock stays stuck below theirs, Jason Hunter warns that what looks like a harmless rotation right now could trigger a much more concerning unwind. Essentially, investors wouldn't just be rotating money around, they'd be yanking their cash out of tech entirely, setting off a painful sector-wide sell-off. And just how painful could that sell-off be? Well, if that resistance isn't broken, the semiconductor index is staring down the barrel of a devastating 28 to 32% pullback from its June high. That is massive. That's billions in wealth erased. Now, to be fair, markets are dynamic. Some analysts argue a drop of that magnitude wouldn't necessarily be the end of the world, but actually a generational buying opportunity. It would totally reset the board for investors who've been sitting on the sidelines with cash, just waiting for a chance to buy the dip.
Let's bring it all home in Part 5, Rotation or Tech Unwind, the verdict. We are standing right at a crossroads here. On one hand, you've got the optimists. They look at this passing of the baton from software to hardware. It's a perfectly healthy rotation. To them, cooling off these overextended tech gains actually builds a stronger foundation, making the whole AI rally way more durable in the long run. But on the other side, the pessimists look at the exact same data and they just see red flashing lights. They see those negative cash flows from massive spending, and they see the year 2000 all over again. They're terrified a major unwind is right around the corner. So, as we track these critical price levels over the next few weeks, this is the ultimate question you have to keep asking yourself. Are we watching the healthy maturation of an AI boom, or are the cracks showing us it's the year 2000 all over again? The data's out there, the technical battle lines are drawn, and the market is about to show its hand. The only question left is, are you positioned for the rotation, or are you going to be trapped in the unwind? Thanks so much for joining me for this explainer. I'll see you next time.